Welcome to the Ncast Monthly Regulatory Brief. I'm Aileen McDonough, your host and Director of Content Marketing at Ncontracts. In this podcast, our compliance team provides an overview and analysis of the latest regulatory changes for financial institutions, along with info on trends to help you keep up with the rapidly evolving nature of compliance. Let's get started.
Hello, I am Stephanie Lyon, Vice President of Compliance at Ncontracts. Joining me today is Katie Ferrell, Regulatory Compliance Expert, and Shelby Montgomery, Regulatory Compliance Counsel at Ncontracts. Today, we're going to cover topics that are really important and interesting for financial institutions in the month of April. And we hope we're able to deliver some really valuable content regarding things you need to know about and things you should act on. On that note, I'm going to hand it over to my colleague, Katie.
The CFPB was very busy in April. As we know, foreclosure moratoriums will expire right around the corner on June the 30th. And so the CFPB has been very active with communications to mortgage servicers. They issued a rule to extend the pre-foreclosure review period until December 31st of 2021. What does this mean? The CFPB just really wants our mortgage servicers to be proactive. Work with your borrowers who may need assistance with loss mitigation applications. And most importantly, do all that you can to help homeowners stay in their homes. Industry data suggests there will be over 1 million homeowners who will be exiting the forbearance period in September and in the following months. So the CFPB has made it very clear that being unprepared is unacceptable. They also issued a compliance bulletin to mortgage servicers stating just that. So pay close attention to what the CFPB is communicating probably for the remainder of the year. And mortgage servicers out there, be proactive, work with your borrowers, and pay close attention to what the CFPB is putting out.
Perfect, Katie. It's not such a small threat to financial institutions that they're not going to accept unpreparedness. So
absolutely.
We're going to stay on the lending space for a moment and turn our attention to what the GSEs are doing. Shelby, tell us a little bit about that.
Yeah, so effective May the 1st of 2021, which if you're just listening was 2 days ago, Fannie and Freddie, their automated underwriting systems will no longer accept new loans submitted using the legacy formats, using the legacy URLA. So we all know that was redesigned and put in use earlier this year. There are some exceptions to that. They will accept some resubmissions, but for the most part, again, effective May the 1st, Fannie and Freddie no longer accepting new loans submitted through their automated underwriting systems using the legacy format.
Perfect. So it's definitely time to check out what your forms look like for compliance and otherwise. So let's move on to a different topic. It's all about diversity, equity, and inclusion, which is a hot topic in the industry and not just financial services, but everywhere. We've been hearing about initiatives in this space, and the regulators have even started to ask financial institutions to collect self-assessments on DEI efforts for your institutions. We have Congress now involved scheduling hearings on this topic. So we know that this is a fast-moving area and space. So it's a good time to think about what you're doing from an HR perspective for DEI, as well as from a lending, deposit, investment-related perspective to ensure you are definitely serving the communities in which you operate. On that note, let's move on to some state issues, starting with New York.
So New York has recently passed their LIBOR transition law. And what this means for you, we all know LIBOR is expected to end at the end of this year. And so for those loan documents, deposit product agreements that rely on LIBOR in New York, that do not have a fallback language to a fallback rate, those documents will automatically now fall back to a rate established by either or recommended by the Federal Reserve or ARC. And so it's a pretty big deal because we're hoping that other states will follow. And in fact, we just found out this morning that Alabama has also passed its own LIBOR Discontinuance Act. Ultimately, we would hope that the federal government will pass some type of similar legislation and make the transition easier for everyone. But for now, we've got New York and Alabama getting in the game. So that will be a topic to follow for you in your states.
Yeah, and I know, Shelby, you don't like to rely on congressional acts for financial institutions to start taking action. So definitely look at your state and look at your contractual provisions. On that note, there is something that we want to talk to you about, which is a really, really important topic that you've heard for a long, long time, and that is the Telephone Consumer Protection Act. I'm going to let Katie tell you about the latest legal development on that law.
The Supreme Court on April the 1st, in the Facebook case where a plaintiff was claiming that Facebook was not communicating legally with them, defined the elusive word auto dialer. What is an auto dialer? It's a device that has the capacity to store or dial using a random sequential number generator, which is a mouthful. And what does that mean for financial institutions? Well, some say that it's definitely a win for financial institutions, that it lessens the risk that could be associated with TCPA liability. But I would caution our listeners to remain on this topic. You know, there's a lot of articles that have been written that say that you can probably communicate with your consumers in this fashion, or you might be able to communicate with your borrowers in that fashion. So I strongly encourage you to pay close attention to this ruling and how it will ultimately affect financial institutions. Remember that states may determine after this ruling to write additional laws that protect consumers. Remember that communication with borrowers regarding debt collection falls under a different umbrella. And I think what's important is to always stick to, you know, our consumers' communication preferences are important. And so just take this one and apply it to your financial institution, but pay close attention to anything else that may develop after this one.
Thank you, Katie. I know that probably and might be able to are not the best words that compliance officers are looking to hear when they're trying to apply an interpretation of the law, but it is definitely full of risk and it's going to continue to have risk in that space. So talking about communication, FinCEN is looking for your comments through the issuance of an advance ruling or advance notice of proposed rulemaking. They are really interested in hearing about beneficial ownership registry. You might remember last year there was a major legislation that passed that affects FinCEN and their need or requirement to implement that law and pass some kind of beneficial ownership registry. What does that mean? Well, a few years ago, we had the customer due diligence law or requirement come through FinCEN, and financial institutions that had depository accounts or loans for corporate accounts, corporations, and those types of things, they had to start collecting additional information. So FinCEN is asking for financial institutions' opinions on how they should go about getting this information collected from the corporations themselves so that financial institutions can utilize this registry to meet their CDD or customer due diligence requirements. Something else I want to note here is this is definitely your time to be heard. We like to complain a lot about how regulations get written, and this is the time to tell them that's not going to work operationally. Those are the types of things that FinCEN needs to know about because they don't know about your systems as well as you know about your systems. So let them know how this could or couldn't work out or how this may shape up, especially as BSA or the Bank Secrecy Act is a space where we're spending a lot of resources, both in software and folks, to handle our risk in that space. So let them hear you. Then we're going to move on to climate risk assessments, which is somewhat of a new topic for us. Katie, take it away.
There has been a lot of conversations, a lot of speeches about climate risk assessment. The Department of Treasury, the Federal Reserve banks, trade groups such as the ABA with this spring have really begun the discussion about climate risk assessments and financial institutions being prepared to conduct those in the near future. The United States is actually a little bit behind in this area. Europe, Canada, Asia, they have been conducting climate risk assessments for financial institutions for some time now. And I think it's just a matter of time before our regulators issue some supervisory guidance related to climate risk. In the United States in 2020, it was record wildfires for our country, as well as the most land-making hurricanes ever recorded. So this is definitely a risk assessment that could impact your lending portfolio. Considering your footprint when it comes to the carbon economy, being prepared is really what I view this topic being all about. I think it's not a matter of if, it's a matter of when. So pay close attention to this topic as well. And more than likely, you'll add it to your suite of risk assessments, just as you do for information security, BSA, et cetera. On that topic, the states are already really making some developments in this area. Right, Shelby?
Yes, I feel like I should wear my I Heart New York t-shirt today, but we're going to talk about New York again really quickly. Their Department of Financial Services started issuing guidance back in October, and the first guidance they issued just advised all state regulated institutions, so banks, credit unions, and mortgage companies, to start considering the financial risk associated with climate change for their institution. And along with that, back in February, for banks, again, the New York Department of Financial Services issued guidance offering CRA consideration for those banks' financing activities for climate resiliency in low and moderate income neighborhoods. So again, New York starts it, and we'll probably see other states follow suit.
Thank you, Shelby. And I know you're not even from New York, so this is unbiased love you send into New York today. All right. So the CFPB has also been issuing their annual reports lately. The latest two that we saw from their office was on complaints, and then the second one was on fair lending. What I love about these annual reports is we get a lot of really good trends from the reports and understanding of what is failing across the world or the US. And so financial institutions can do it better. And I'll tell you, our examiners are looking at those reports just like we are. So they're going to be focusing on areas where they know there's a lot of room for improvement. And on a complaint area, the number one place in room for improvement is on Fair Credit Reporting Act responsibilities. They have noticed a hike of complaints on the fact that consumers are saying there's a lot of inaccuracies in their credit report. This is really, really problematic because, as you know, financial institutions are some of the number one reporters that talk back to the credit reporting agency. So make sure that if you have a complaint about an inaccurate credit report or something that you've reported, that you have the procedures in place to go ahead and correct it, because you do have timeliness requirements, you do have accuracy requirements, so keep those in mind. From a fair lending perspective, of course, there is a lot of Regulation B violations across the board. Number one area that they see it is in the most worrisome one, which is the anti-discrimination on the 7 prohibited bases by the Regulation B. So make sure that when you are going through a lending transaction, regardless of who it's for, a business, a consumer, a small, creditor, anything like that, that you're really paying attention to the credit worthiness of the borrower and not the characteristics of the borrower. There's also a lot of issues around adverse action notices and sending them out in a timely manner. If you're using a third party for that, this is the time to do some due diligence on your third parties. And finally, we're also seeing a lot of issues with small business or lending. The reason for that is, of course, the pandemic took a really hard hit on these small businesses. They required a lot of assistance through PPP loans. And the CFPB in their annual report noted a lot of deficiencies in that respect. So those are areas where our regulators, regardless of whether or not you're supervised by the CFPB, the other regulators will also be turning their attention to those areas. So make sure you do too. On that note, Shelby, you started talking about the Community Reinvestment Act, CRA, but now let's shift focus from New York to Illinois and tell me what's going on there on the CRA front.
So Illinois has passed its own state CRA and applies to state banks, credit unions, and non-bank mortgage lenders. And it's a pretty big deal only the second state in the country to apply the CRA to both credit unions and non-bank mortgage lenders. So it was a bit controversial. Banks and credit unions did not get to put in as much input as they would have liked. The bill came along as part of a larger package of bills meant to address racial injustice, and it was introduced and 3 months later was passed. So a little frustration on the part of financial institutions because it kind of slid under the radar, but it has been enacted and everyone needs to get on board.
That's not the only thing that's happening, right? We also have Congress looking at CRA as well as some cybersecurity issues. Why don't you cover both things, Shelby, and tell us a little bit about why Congress is getting involved with CRA now?
Congress is getting involved mainly, again, because of the credit unions. I think Katie may be able to talk more on that.
Sure. Just last week, Senator Elizabeth Warren and some fellow lawmakers reintroduced the American Housing and Economic Mobility Act of 2021. And if this one continues on, it will have a major impact on banks, credit unions, and mortgage companies. From a bank perspective, it will expand some of the assessment areas. It will also enhance disclosure requirements. And like Shelby just mentioned, from the state side, to follow suit there, it will include mortgage companies to be subject to CRA requirements. From a credit union perspective, although the act does not fully place credit unions under the full scrutiny of the CRA, it does add some additional requirements to them. So this one is a big one from a CRA perspective, and we shall see how it plays out, but it will involve a lot more players when it comes to CRA.
Perfect, thank you. And for federal credit unions, that's definitely one of the first times you probably have heard of Community Reinvestment Act. So it's time to brush up on that just to understand basically what this all means for you. So the last topic here that I think everyone should know about is cybersecurity. That's a big deal. Privacy. We've seen a lot of legislation across the board. So Shelby, I know you're tracking a lot of what's going on the state side. So tell me a little bit about that.
Yeah, cybersecurity has become a huge deal, mainly due to COVID-19. People working from home, everyone is much more concerned about it, it seems, lately than they have been in the past. But recently, some states have been working to enact cybersecurity safe harbor legislation, which would provide your institution with an affirmative defense against certain cybersecurity claims when a data breach has occurred. Utah being the most recent to pass this legislation, and Connecticut has introduced similar legislation on their books. So those will be things to look out for, but may give you a little bit of comfort if there is a data breach in your institution to be able to defend against it.
Perfect. Thank you, Shelby. And now we're going to move on to things that depository financial institutions would care about, such as banks and credit unions, starting with the Safe Banking Act. That is something that should not sound that new to you. We have seen a similar legislation passed last year through the House. It never made it out of the Senate. But generally, what it's all about is cannabis and cannabis-related businesses and allowing financial institutions to finally bank them at the federal level. As you all know, there's so many states out there, about 37 plus, that allow some type of legal marijuana or cannabis use. And what Congress is trying to do is it's trying to allow financial institutions to bank them should they choose to, and remove some of the risk of being a cannabis business, because there's a lot of cash involved, as you can imagine. People who work for these institutions can't get a direct deposit. They can't do their lives like most of us that are working for other types of industries can. So they're trying to make it safer for all players involved in those spaces. And so the exciting thing about the Safe Banking Act is it has passed the House with a lot of support, and it has now moved on to the Senate, where it can either go thrive or die. Last year, it did not thrive. This year, we're hoping that there's a little bit of a different desire to move it along, and we'll keep you posted, and we'll probably be talking about this for the next few months until there's some type of voting related to this legislation. If you are interested in commenting, you can definitely check it out. It's something that's out there right now being discussed. So we also have a lot of other things regarding risk management that the regulators are talking about. So Katie, tell us about that.
Yeah, and so the cannabis topic is a great segue for a recent proposal for comments. The FDIC, the OCC, the FRB, NCUA, and FinCEN all collaborated to issue a proposal for comments regarding model risk management as it relates to Bank Secrecy Act and anti-money laundering software. As we know, many financial institutions are using software to manage BSA risk, to monitor transactions, and to potentially fight financial crime. And the agencies are really, for the most part, seeking advice and seeking information from the industry so they can best determine how to provide guidance in this area. The request for information also, there was a statement that came along with it. And for the most part, the agencies are really needing the financial institutions to show that they are monitoring the software responsibly. They are having it validated by someone with expertise. The configuration of the software is appropriate for the risk profile of the institution. Thresholds, alert monitoring, and all of the above. The agencies really just want to know more, is my opinion on this. So I highly encourage, if you're utilizing software to manage BSA, AML risk, please comment. Especially with cannabis on the horizon, that may be something that you would like to consider if your institution is wanting to get into that area. But please comment. They are due by June the 11th.
Perfect. And we have talked a lot about other states, New York, Illinois, and so forth, but we have not covered a very popular state and what they're up to. So Shelby, tell me a little bit about California and what kind of crazy things they're engaging in nowadays.
Yeah, so California is never without controversy either. Has introduced a public banking bill, and basically it's the intention to kind of create a public bank that allows for zero fees, zero everything, to help those underserved communities in California as far as banking services go. Trade associations in California are completely up in arms about this. I think there is some controversy over the data that's used as far as establishing the percentage of affected residents, with some numbers out there reporting as high as 40% of residents are not being served by banks and credit unions. Of course, the trade associations are saying this is premature, that banks and credit unions currently offer products to everyone that are fairly similar to what is being proposed here in this bill. So it was scheduled to be heard last week, and we'll keep following and see where it goes.
Perfect, thank you. And you're right about the state of California. It's never without interesting news to report. So that does it for depositories. Why don't we move on to regulators that affect banks, such as national banks and state charter banks, starting with the OCC. Katie, what is the OCC doing?
OCC's been busy. They issued their third conditionally approved bank charter to a crypto bank. This crypto bank is Paxos, and they are a stable coin issuer, and they deal in bit currency. I'm learning too some of the lingo here, but they joined Anchorage and Protego, the other two companies that the OCC has issued a conditionally approved bank charter for. This particular topic kind of, there's those that strongly oppose it and those that strongly support it. From the opposition side, the ABA, for example, felt that Paxos's application for a charter was vague and unclear about the services that they are providing. And then other such as the Federal Reserve speech just last week, highly supports the OCC in its efforts to expand the services that are provided under its umbrella. So just remember, this is a conditionally approved charter. And what that means is Paxos, just like its peers, has 18 months to essentially prove to the OCC they can operate safely and soundly, as well as according to the business plan they submitted with their application. So this is number 3. We'll see if the OCC issues some more in the coming year.
It's a really interesting space right now, especially as banks are thinking of providing these types of services as well. So another risk consideration here, especially on a very ever-evolving landscape of cryptocurrencies.
Absolutely.
But the OCC is not the only regulator that's been busy. The FDIC has also been doing some things. Shelby, what have they been up to?
So we really just kind of want to put this out there for you to be on the lookout for, but the FDIC is currently seeking comment on a proposed rule related to advertising, specifically prohibiting people from making false or misleading representations about deposit insurance, or from using the FDIC's name or logo in a manner that would imply a product is insured when in fact it's not. So I think advertising maybe sometimes gets overlooked. We put that FDIC logo on everything at a bank and don't always pay attention to whether or not it could be considered false or misleading. But this is a rule to keep your eye on and comment on if you'd like.
Thank you. So on the credit union side, we also have our NCOA regulator who is recently, and this is not that recent, but they passed a regulation allowing the expansion of suspension of services to members that are acting out. However, Congress felt like they didn't go far enough. And I'm really excited to see a bipartisan piece of legislation out there that can assist with this process to expel members that are acting out or acting illegally or dangerously to people in the financial institution, the credit union. There's a lot of stories out there of tellers being harassed, threatened by customers of their members, and people being scared to go to work. And credit unions federal credit unions actually have to hold a special meeting of members to vote people out. So Congress, through the Credit Union Governance Modernization Act, is trying to improve that and add a for-cause provision to be able to quickly expel a member who is acting, again, disruptively, illegally, hazardously, and just the people that you don't generally want in your institution. So we'll see what happens with this piece of legislation that has strong support from, like I said, both parties, especially because there's a lot of state charter credit unions and states that already protect institutions this way through language that is for cause. So it's very important for federal credit unions that they also have that for-cause provision, and we hope to see that pass really, really quickly and make sure that institutions can protect their employees. We also are going to wrap up with our mortgage companies, and on that note, Shelby, you want to take it away?
Yes, so credit unions are not the only ones trying to modernize at this point. The Conference of State Bank Supervisors is seeking input from NMLS users, that's the Nationwide Multi-State Licensing System, on proposed requirements for modernizing the NMLS, basically trying to standardize an approach across all states for the licensing process that is there in NMLS, rather than having kind of this hodgepodge of state laws everywhere. So public comments will be accepted by the CSBS until May the 31st. So if that's something you'd be interested in commenting on, again, check into that.
Great. Thank you so much, both you, Katie and Shelby. As you can see, the regulators were really, really busy in the month of April. If you want any more details on anything we talked about today, check out our compliance management software, Ncomply, where you can look at the latest on regulatory news, guidance, legislation, and regulation. Thank you.
That wraps up this month's Ncast Regulatory Brief, talking with our compliance experts about the latest regulatory changes you need to be aware of. If you liked what you heard, please leave us a review. And if you're not subscribed yet, we invite you to do so on your favorite podcast platform. Thanks for listening.